Teladoc reported earnings about a week or two ago, and it was about time for me to upload this video. Hello everyone, welcome back to the channel. Today we're going to talk about Teladoc, their earnings, their growth, and my position in this company. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. We all know that Teladoc stock is down over 52% since its highest, and it is even down almost 3% today. Teladoc is mainly a telemedicine and virtual healthcare company which offers telehealth and uses AI and analytics to be able to help patients more accurately and grow. Mainly, we are able to talk to a doctor, therapist, or any medical expert anywhere on a video call. First of all, they reported a revenue of $503 million, which is a growth of 109% year over year. Adjusted EBITDA of $66.8 million and raised their guidance once again for 2021 to a revenue of between 2 to 2.02 billion dollars, which is obviously nice to see from companies like this. Now, here is something people did not like, and it is that visits fees increased only 1%, while access fee revenue grew 138% year over year. More on that later. Then their US revenue grew 121% and international revenue 24% year over year. Even though many do not like that their US paid members are not seeing a huge growth, let me tell you that 52 million paid members in the US is huge for this country. Still, they were able to see a nice growth on PMPM revenue per member per month, meaning that not only they saw a teeny tiny growth in members, but members are adding more products or services, which is why their PMPM is growing year over year and quarter over quarter. Then chronic care enrollment has constantly increased, as it means people or members have continued enrolling to more programs as well. One of the most important questions I had before investing in this company was if utilization was going to drop, as people are more comfortable now going back to hospital or going out after vaccines and COVID cases decreasing, which obviously could hurt Teladoc. This was normal to expect, as we all expected that to happen with e-commerce, food delivery, and many other industries. And we have seen how e-commerce has slowed down a bit in comparison to 2020, because 2020 they accelerated their growth. But still, nothing bad happened. The thing is that virtual visits became more normal last year as the pandemic accelerated the adoption of virtual care, which is why it is very impressive to see that Teladoc utilization is growing, and that the percentage of its members who are taking advantage of virtual visits continue to climb year over year and quarter over quarter. Now, in here we can see that most of their revenue comes from access fees, which grew 138% year over year. As said before, while their visit fee grew only 1%, which is why many people actually did not care about the 1% growth, as most of the revenue comes from the access fees and not from visit fees, and the growth is still there, meaning that they don't only make money from people video chatting with doctors. Now, on their segment from operations, we can see that the revenue grew 109% year over year, but their gross margin improved year over year from 62.3% a year ago to 68% this last quarter, which is obviously a good sign for this company. The thing is that we can see that their expenses increased massively as well. Their advertising and marketing grew 116%, sales 241%, technology and development 250%, and general administrative 96%. A lot of this can be explained as they are reinvesting a lot of money into their own company, research and development as well, and all that, but it better be worth it, because when marketing is growing more than their revenue, it means that advertising is not being that effective, and it is obviously not good for the company, as they are burning cash and not getting anything in return. They reported a huge net loss of $133 million, which is what many questioned. When are they going to be able to be profitable? But we gotta take into consideration their Livongo acquisition, as that is getting factored into this net loss. This net loss includes $82.9 million in stock-based compensation, which is a massive increase year over year, but this reflects higher expenses associated with Livongo stock awards that continue to vest after the merger, and also factors in amortization from the merger. I'm not saying that they are profitable without that. No, what I'm saying with this is that they are still having a lot of expenses due to the merger with Livongo, which is obviously negatively impacting their income statement, as you can see, and net loss, and also impacted their balance sheet, and you're going to see how. First of all, they have a lot of cash, $733 million in cash and cash equivalents, $1.1 billion in current assets, which has slightly increased since December, and have total assets of $17.6 billion, which obviously when we look at that, it looks amazing, but the truth is that I like to take out the goodwill and intangible assets, as I have said before in many videos. Without that, they would have total assets of $1.19 billion, but have a nice current ratio of almost 4, which is obviously very nice for such company that is reinvesting so much into their company and just acquired Livongo last year. Something I do want to say is that we gotta understand that Teladoc is not trying to disrupt the healthcare industry or substitute the physical healthcare system. Their main goal is to basically be the first point of entry to the physical system that already exists using artificial intelligence, data collection, and technology. They want to transform and improve today's healthcare system by being part of it, not by substituting it. I do have to say that I understand that many don't like this company because of the growth in their expenses and not seeing the effectiveness in it, as they are growing more than their revenue, and it actually makes us wonder when they are going to turn profitable. Still, analysts are expecting the company to report final loss by 2023 before turning a profit of $428 million in 2024, which means that the company needs to have an annual average growth rate of 64%. Still, being honest, I have to say that I obviously do not like the company underperforming and missing quarter-over-quarter earnings expectations, as you can see here, which is one of the things that make me doubt and wonder about this company and my current position. This stock is currently trading at $139 per share with a market cap of $22 billion with a price to sales ratio of 13.64. Another thing here is that yes, they are expecting a nice growth of about 83.9% year over year for 2021, just like what analysts are expecting, but analysts are expecting a 28% growth only for 2022. And we just said that the company needs to grow on average 64% year over year to be able to achieve profitability as planned. This is the only thing that makes me wonder, because the company is certainly having an excellent revenue growth. International expansion, very innovative, utilization keeps growing, revenue per member per month keeps growing, and all that. Overall, it is a nice company with a nice growth, but the only thing that makes me wonder is that they are missing expectations, making me wonder if they will be able to achieve profitability anytime soon as analysts expect it to. For that, we would have to wait and see, as this is a long-term play. I would not invest in this company in the short term, in any company, but in this company in the short term. But those thoughts sometimes make me wonder if I should sell or hold onto the company. Analysts are certainly expecting a nice run for this company in the next 12 months. On average, they expect the stock to go up 33% or as high as 109% in the next 12 months. As the stock is down today, I am also down. I'm still down in my position 21.74%, as my average cost is $177.73 per share, and it represents 5.24% of my portfolio. I started investing in this company back in March when it dropped below $200, and I have bought all the way between $197 to $139 today. I bought a single share today, not more, as I don't want to buy more of this stock right now. I'm not planning on adding more to this position, as it is already over 5% of my portfolio, and I like 5% to be the top for my investments even though I did not follow that with 3 of my investments, but slowly that will change as I invest in more stocks or increase my positions in other companies. I feel comfortable with my position size in this company. I do see nice growth for the telehealth industry, and Teladoc is very, very well positioned. I expect nice growth long term, and I'm for now holding this stock. Again, I don't like that they have underperformed in the past quarters, and it is definitely something I have in mind, as it makes me wonder if I should just sell and move on, but I have not decided yet, as I like the industry that they are in. As of today, I'm holding this stock. Would like to know what your opinion is in this company and what you expect from it and from this industry. Hope you enjoyed the video. Please smash that like button and subscribe, since it really, really helps the channel out. Thank you, and see you next time.